And Dennis, take it away.
Okay. Okay, good morning and welcome to the Kushner Report for May of 2023. And at the end of the presentation today, we'll have an opportunity to participate in our question and answer session. So hopefully you'll engage in that part of the process in our program later today. So first of all, I'd like to kind of go over the agenda today. We're going to talk about key economic indicators, the global economy, the domestic economy, mergers and acquisitions, other significant economic news. And then I want to take a look today at the venture capital and private equity. What are they? How are they different? And then what is the outlook for both segments for 2023? So let's start with venture capital. So what is venture capital? Well, venture capital is really a form of private equity and a type of financing that investors provide to startup companies and small businesses that are really believed to have long-term growth potential. And the venture capital generally comes from well-off investors, investment banks, and other financial institutions. And there's really 5 key takeaways here. So first of all, number one, venture capital is really a term used to describe financing that is provided to companies and entrepreneurs. The venture capitalists can provide backing through capital financing, technology expertise, and or managerial experience. And myself and Ed Snyder have been through that, where we've been involved in engaging with people, trying to help them get their businesses off the ground once they get investment capital. Venture capital also provided at different stages of their evolution, although often it's usually early stage or seed type of money is where that money takes place. And the venture capital funds really manage pooled investments in high growth opportunities in startups and other early stage firms that are really typically only open to accredited investors. And then we have a venture capital's evolution is really from a niche activity. This started at the end of World War II, if you can believe this, when sophisticated industry and multiple players began to start important role in spurring growth and innovation with small startup companies. Now, there's really 5 key trends that are taking place. First of all, you have what they call the bid-ask spread is reversing. That is, for the past 3 years, VCs and their limited partners have wanted to deploy their surplus, or what we call dry powder, that is funded for new starting activities. In many cases, a lot of those people sat on the sidelines and just kind of watched to see what was happening with the economy. Valuations are facing downward pressure. So founders believe that their portfolio startups are really undervalued and that early stage private businesses are really overvalued. Now, VCs know that the reason behind the decrease in valuation is because stocks are constantly being repriced and startups are only basically valued down when they announce a new round of funding. So for example, a colleague of mine was a vice president of operations with the firm, and they were refunded 5 times, and each time they kept adding more and more stock, and therefore his value kept getting diluted. So that's an issue you face when you keep getting more and more runs of investment. VC funds are really temporarily experiencing more negative returns at this point. So during the first half of 2022, during the COVID timeframe, analysts were surprised when VC funds reported multiple negative returns for the first time in more than 5 years. Now, VC due diligence is finally getting its due, and that is today the venture capitalists are returning to their original goal, and that is buy low, improve, and exit high. So to identify what low means, they need to look at the proper due diligence and not just take shortcuts. So we're seeing that taking place more today than we have in many, many years. VCs are also adopting new technology to work more efficiently and more effectively and outperform their rivals. One of the biggest moves you can make is to increase your odds of finding and landing the most fruitful VC deals. That is without looking, for example, at the inefficiencies that really create above dismal statistics, is really to adapt new technology and to streamline processes to get things done more efficiently. And statistics have really shown that the average successful VC deal may require almost 120 hours of due diligence just to obtain and close a deal. And for every check written, that's approximately 250 deals that are looked at, only 1 or 2 are taken. So you've seen a very low form now of how many are being invested. Now, what does the outlook look like for the rest of the year? So first of all, the industry remains highly active with significant levels in the investment opportunities in startups and emerging companies. Alone in 2022, venture capital recorded a record $350 billion in startups and emerging companies. Looking ahead this year, it's likely the VC marketplace and industry in the US will continue to grow, driven primarily by strong investment demand and a healthy pipeline of promising startups. Overall, the outlook for VC marketplace in the United States is positive, but as with any investment, it's really important to carefully evaluate the risks and potential rewards that we're seeing when making decisions. So that kind of gives you a cut on venture capital. Now, on the other side of the fence, we have what's called private equity. So what is private equity? Well, private equity is a form of financing where money or capital is invested into a company. Typically, PE investments are made into mature businesses. Again, I repeat, mature businesses in a traditional industries, exchanging for equity or ownership stake in the company. PE really is a major subset of a larger, more complex piece of financial information from that perspective. And so what happens is that unlike VC firms, PE firms are often taking the majority stake. So for example, many times they'll take greater than 51% of the company when they invest, or even take over the company completely. Private equity firms usually have a majority ownership where companies once stood on their own. And then how does private equity work? Well, to invest in a company, private equity firms at the very beginning, what they do primarily is to raise a pool of funds, of capital from limited partners. And once the pool is raised, they'll close that pool down. They'll go out and look at companies that they want to invest in or they want to buy. So when a PE firm sells one of their portfolio companies to another company or an investor, the firm usually makes a profit and distributes that profit to those that returns, for example, for those that were limited partners when the deal was initially started. What are really the three main strategies for a PE investment? So first of all, you have a buyout. And that is, a buyout is when an investor purchases a majority of stake in a company. The most common type of deal is called a leveraged buyout. Now, in a leveraged buyout, the investor purchases a controlling stake in the company using a combination of equity and a significant amount of debt, which must equally be repaid at some time when the company exits. Then you have a growth situation where sometimes instead of purchasing a majority stake in the company, an investor will acquire a minority stake looking to further grow the business. And you see that happen in a lot of the software companies in Silicon Valley. Then we have what we call mezzanine. So mezzanine is a unique strategy within the private equity arena. It really bridges the gap between debt and equity. So when a company receives mezzanine financing from a private equity group, it takes on debt capital with an agreement to pay it back. Now, essentially, that means that the debt can be converted to equity down the road. Now, how do they make money? Well, PE funds collect both management and performance fees. That's where you make a lot of money. So, for example, calculated as a percentage of assets under management, typically you're talking about 2% of the value of the company will be as part of those fees and management fees upon completion of the deal. And what are performance fees? Well, they're calculated based upon a percentage of profits from investing, typically around 20%, which is significant. So these are fees that are intended to incentivize greater returns and are paid out to employees with rewards and bonuses as well. So what are some examples of large private equity firms? Well, here's for example, you've got the Blackstone Group, which is headquartered in New York City. You have TPG Capital, which is in San Francisco, the Carlyle Group, which is a large group out of DC, and then you have Harbor Best Partners, which is located in Boston. These are four of the major players. So what is a private equity investor? Well, it's an investor working at a private equity firm or called private equity investors. They're really critical to raising capital as well as identifying companies that make good investment opportunities. Think about the company that Microsoft just invested $10 billion on, which is with that ChatGPT AI that's moving forward. They got involved and they put $10 billion into that investment, which is really going to pay tremendous amount of returns down the road. Really, what are the differences between the two, venture capital and private equity? Well, private equity really refers to investments or ownership in private companies. It's also used as a term for PE strategy investing, where venture capital is mostly early stage companies. At some point in time, they get their money back and they move on to others. So the unique characteristics of private equity would be, for example, you've got PE often invest in mature businesses in traditional industries, which is common for the most part. And using capital, investors promise returns. Typically, they take a stake greater than 50% in a company that they're going to invest in. And many times they'll either put people on the board or they may take an active role in managing the company. And when a PE firm sells one of its portfolio companies to another company or an investor, returns are distributed to the PE investors, which is an incentive to invest the next time they open up a fund. The uniqueness of characteristics with venture capital, well, VC firms invest in tech companies, primarily startups, and young companies in their seed environments, just getting started. So VCs basically usually take a minor stake in the company, rated less than 50%. Many times it's 10 to 15%. And if they keep putting money in, they'll take a greater percentage of that. And of course, most of these companies are not fully established or profitable. So they can be very risky investments. And then you have the firm that's making a profit. If the company they've invested in goes public or gets acquired, by selling off the shares, the investors will take in a lot of profit. So what does the outlook look like for the rest of this year? Well, the outlook in private equity industry in 2023 will depend on various factors, including the state of the economy, interest rates, and regulatory environmental issues. So economic growth is really a key driver of private equity, as companies tend to perform better in a growing economy. Interest rates also play a large role in this area. It's important to note that private equity industry is subject to market fluctuations and uncertainty, and predicting the outlook for any year can be very difficult. So you have to watch what goes on now. And of course, the last 3 years, it's been up and down because of pandemic and coming out of things and supply chain and everything else. So there's been a lot of disruption, but in general, there's a lot of money on the sidelines waiting to be invested. Now let's take a look at key economic indicators. We want to take a look today at the gross domestic product, inflation, unemployment at the federal and the California level, and also the price per barrel of oil. So looking at our statistics here, the key drivers, if you will. So the global GDP around the world is predicted to go out about 2.4% this year, and then edging up again to 3% next year. Now, if you look at the US GDP for this year, it's projected to go out about 1.3% and then dropping down to 3%. And that's predicated on many economists believe that we will enter a recession sometime in the next few months, and that will go through a greater part of 2024. And we'll see how that goes. So we're still in May, and we've got one more month to finish the second quarter of 2023. In terms of inflation, the good news here, the projections are that possibly by the end of the year, we'll see inflation around 3.5% and dropping down to 2.4%. As you know, the target range is in the 2 area, which may take some time into 2025 to reach that objective. The unemployment rate on a national basis is projected to go out about 3.7 this year, and inch up to 4.6 next year. Again, that's tied to the potential of a recession. The state of California, on the other hand, we're looking at 4.5% unemployment this year, and then going out next year at 5.1%. Keep in mind the California economy is usually the last to go into recession and usually the last to come out of it. In terms of the price per barrel of oil, right now we're looking still at a range of $80 to $100 a barrel. And I'll talk more about that when we talk about the current rate. Now, looking at the global economy, a lot of activity over the last month. For example, Sweden took another stand and raised their interest rate 50 basis points. So that's up to about 3.5% right now. And again, that's based upon what's happening with inflation. The Bank of Australia, the rate hike, they did a 25 basis point rate hike last month, and that's up to 3.85. Again, the idea here is to get the inflation under control. The European Central Bank, again, the same. 25 basis points, and the Bank of England did the same with mixed rates, again, 25 basis points, which is now up to 4.5%, really almost on par with the United States. In Mexico, they tightened, they took a very aggressive role earlier. They've ended their hawkish movement. The overnight rate in Mexico, as of right now, as of last Friday, was 11.25%, significantly higher than most places. And again, that's to ward off inflation. Now let's take a look at some key economic drivers. So let's look, for example, if we look at the economy in the first quarter grew at 1.1%, which was somewhat flat, if you will. And a lot of that had to do with inventories, surplus inventories coming in and not moving. So we saw that take place. And basically, we still had strong consumer spending, even though we saw growth at 1.1%. The job openings last month dropped down about 300,000, about 9.5 million. In terms of how many of those jobs that are out there that are open are being filled remains to be seen, but there's still a lot of jobs open in the marketplace. And as you know, the First Republic Bank was sold to JP Morgan, and basically that includes $173 billion of loans, $30 billion of securities, as well as $92 billion in deposits. And if you listen to Janet Yellen, they're talking about looking in terms of more banks, larger banks doing consolidations, probably with a lot of the regional banks. You're going to see that taking place, I think, as we move later through the year. Strong fundamentals. So Sid, who's a Texas now and Texican from Florida, lives in the state of Texas. The good news is their economy is very strong. And basically from 210 to 220, they basically posted the largest average annual population gain than any state in the union. Their economy is very strong right now. They're projected to go out to downshift, to go out this year at 3.2% and dropping down to 2.2% next year, but they've still got a very strong economy in the state of Texas. Now, if we look at inflation, inflation dropped slightly again last month to 4.9%, but it's still way above the target. And as you know, for this, the last 10 months in a row, we've seen a decrease in inflation. The Federal Reserve, again, is still targeting 2%. Now, keep in mind that the Fed will meet again on June the 14th, and based upon the level of employment and a few other indicators, you can expect that we will see another 25 basis points raised in June. They will continue to do this until they feel inflation is getting under control. The wholesale index was only up about 0.2 of a point, better than the 0.4 of a point we saw in February, so that's getting under better control. Good news on the trade export standpoint. We saw exports were up by $256 billion last month. It's a gain of 2.1% over the prior period. In the area of the trade deficit, we're still running around 85 billion in March, and that's much better than the 92 to 95 billion we were seeing several months ago. So it's still a lot to be resolved, but it's much better than it's been in the past. Looking at retail sales, they were up by 0.4 of a point last month. Less than expected. They expected that to go up substantially higher, but it didn't. Again, a lot of concerns by consumers about what's taking place. Now let's take a look at the job creation that took place on the national level last month. So payrolls were very strong again. They were up by 253,000 in April, and the unemployment rate dropped to 3.4%. Just of notoriety here, if you look at the professional services and health and education and leisure and hospitality, very strong returns for the month, which is good. And going back to what I've said over the last several months, those two areas really took the hits during the pandemic. Now, if we look at the state of California, the interesting here is, I believe last month we saw 8,700 jobs created. This was a good month for California. It was a creation of 67,000 jobs. And unemployment increased to 4.5%. And just of notoriety here, just health and education and leisure and hospitality really accounted for the majority of the key jobs. So California's economy in terms of job creation is still strong as we head into June. And again, looking at inflation, again, the Federal Open Market Committee, again, as you recall last month, middle of May, they raised it by 25 basis points and has indicated that, the FOMC remains highly attentive to inflation risks and basically said that they'll continue to raise interest rates again if things worsen or they stay flat and we don't see a decline in inflation. So they're going to meet again in June 14th, and many people believe they'll raise interest rates 25 basis points until we can see this number go down. Now, the 30-year mortgage rate, the average rate, came out around 6.96, but yesterday I saw a new rate was at 6.46, still substantially higher than we saw over a year ago. The manufacturing index is a major concern. If it goes below 50 basis points, it says you're either entering or you're in a recession. It closed down again last month to 47.1, up slightly, but it's still below the 50. And that's one particular barometer we're going to have to watch going forward. Factory orders, the good news is the factory orders increased again for the second month in a row, 0.9 of a point. So that's positive from that standpoint. Now you look at small business optimism level. Basically, it decreased by 1.1 last month, down to 89.0. Now, this is the 16th consecutive month and a 40-year high that it's been below 98. There's a real concern there. We've got to get that back up to 100 basis points. Consumer confidence dropped down again in April to 101.3. It's just above the 100 basis points mark. So you see this is slowing down. The economy is slowing down. In the area of crude oil prices, the good news is late May, as early as last night, the oil price was down to $74.23. That's down from a high of $78.88 that we saw in April. Hopefully that'll continue. Looking at the housing market, housing starts, for example, the starts rose by 2.2% in April, which is good for the first time in a few months. New home sales across the country were up about 4.5% across the board, but that's down 36% since the same time frame in 2022. Looking at Southern California, sales were down during the month. So in Los Angeles County, the price of a home of $739,000 increased by 2.8% in April, but the sales were down 8% and down almost 38% over a year ago for the same time frame. Orange County, the value of a home of $1.225 million was up about 2% in April. However, sales were down about 10% and down almost 40% from a year ago. And looking at San Diego, the selling price of $930,000 increased by 1.6%. However, April sales were down by 8.2%, and they dropped by 37% from April of last year. So what we're talking about here is that the sales are down slightly, but substantially over what we saw almost a year ago at this time frame. Now we're moving into the key months now. As we move into May, June, and July, kids are getting out of school. A lot of families like to move at this time of the year, so we'll have to see what happens. I know that with inventory on board, I've talked to some real estate folks, and they told me that there's a lot of homes that are for sale. In some cases, like in Orange County and LA and someplace in the Bay Area, they've got multiple offers on these homes. So that's the good news. The thing that's concerning at this point is the fact that the banks are tightening up the requirements to get approved for loans for homes and everything else. So it's tightening based upon what's happened with those banks that went under over the last couple of months. Existing home sales dropped by 3.4% in the month of March, and that's down 23% from a year ago. Concerns in that area. The good news, construction spending picked up again by 0.3 points in the month. So it's moving in the right direction, and we're seeing that happening with the increase in jobs in the construction industry. So that's very positive. Now we look at the productivity index, which is very important for our economy. For the first quarter, productivity was down 2.7%. So that's not good. As a matter of fact, that's pretty high. And we've seen that the output increased by 0.2 points in hours worked, but in hours being employed. So productivity has gone down. It's got to go in a different direction. So that there's a real problem there. Some of that's attributed to the lack of getting products such as semiconductor chips and things of that nature, but it's still down. That's got to go in a different direction. Now, looking at company displacements for the month, we had several, not as bad as we've seen in the past. However, Chrysler basically is eliminating 33,500 jobs. Most of those are hourly. I'll talk about later in the discussion. The Gap at 1,800, Qualcomm in San Diego, just under 2,600. Morgan Stanley, another 3,000. IBM, another 7,800. Jenny Craig, which was headquartered in Carlsbad, California, is closing its doors on June the 24th, and that'll eliminate 1,000 positions that were in that program nationally. And then we have Shopify, for those that you use that, 2,300 jobs. Good news is United Airlines is hiring 15,000 people. So that's good news as they try to expand the business from where it was before the pandemic. And then we have Sabre Corporation, which is a high-tech firm in the Bay Area, 1,000. For those of you that use LinkedIn, 700. The idea is they're trying to improve operating efficiency, but that's 700. Then we look at Consumer Energy, which is our buyouts, 4,900. Oracle, another 3,000. Then a couple of days ago, I believe it was yesterday, Facebook, another 6,000. So that's kind of where we stand right now. There's a lot of smaller companies and colleges and so forth that are laying people off, but it's below the 500 mark. It's not working. I mean, there's probably 40 from last month alone. Now let's take a look at mergers and acquisitions. And again, when you see the economy where it is today, like it was in 2008, 9, and 10, you'll see more acquisitions and more consolidation taking place in industries, especially if you're a publicly traded firm and you have basically flat organic growth. You're going to have to decide where do you go from here. That is, in some cases, you're going to divest yourselves from certain industries or certain product lines that don't make sense. You're also going to look at buying your competition or getting into new areas. So Yahoo is getting involved in acquiring a company called betting app Wager. And basically, this is a 3-year-old sporting bet startup that's based in Nashville, Tennessee. Terms of the deal were not disclosed. This is an interesting one. Olive Garden is buying Ruth Chris Steakhouse for $715 million. Now, Ruth's Chris Steakhouse began in New Orleans in 1927. They have 154 locations worldwide. There are 80 owned and there's 74 franchises. So that'll be interesting to see that integration take place. That was a surprise. You're seeing more in the retail business. You're seeing there's a million different kinds of mattress companies out there all over the country. Well, you're seeing Tempur Sealy is acquiring Fur Mattress Firm for $4 billion. That's a huge acquisition. That'll take them up to number one in that space. So you're seeing more of that taking place. Then you have U.S. pipeline operator ONEC is buying Magellan, and basically that's a transportation of refined products and oil for $18.8 billion. Then you have Fanatics is buying PointsBet, again, another asset, $150 million firm. Again, they're in the sports betting industry. So you can see different industries taking place across the board. So what other significant economic news has taken place? There's a lot going on, a lot of activity. So first of all, GM and Samsung SDI is investing $3 billion to build a plant for electric car batteries. And the location yet is still on hold. That's to be determined. General Motors is ending production of the Chevy Volt for its first mass refabrication in the electric vehicle business. So you won't see the Volt anymore, which is interesting. Now, Chrysler, as I mentioned earlier, they're offered buyouts of 33,500 hourly employees and then full-time employees over 1,000 as well. And then you have the interesting here is in the Chrysler area as well, they're coming up with some new brands to bring to the marketplace sometime in 2025. Now, FedEx, which is interesting, they're downsizing their flight operations. What they're doing is essentially they're going to cancel bases in Alaska, California, Germany. And the idea is to improve overall operating efficiency and profitability for the company. And I mentioned earlier, the Federal Reserve and the federal banks are basically going to change banking rules in the aftermath of the Silicon Valley meltdown and failure. So what you're going to see happening is you're going to see tighter requirements taking place on loans, et cetera. The other thing is, for those of you in banking, and I know like Tom Croney's on the call today, you're going to see an inclusion of more stress testing and liquidity requirements taking place. So you'll see more due diligence taking place in the area, especially with regional banks and the small local banks as well. Now, in the last 4 months, there have been 70 major bankruptcies in the United States. And if you look at it from perspective, in 2009, there were 118 that took place through April of that year. And during 2020, there were about 71. So we're seeing that activity taking place now, and we'll see that grow as we go further along. But what's interesting here, here's some of the notable companies. So you have Bed Bath & Beyond. Unfortunately, they will close probably around sometime in June. You've got David's Bridal. We mentioned them in the past. There's a company called Boxed, and this is an e-commerce platform company that sells wholesale consumer goods. Independent Pet Partners, Pet Supplies, Tuesday Morning, Serta Simmons Bedding, Party City, and also Formula Brands, which is for beauty products. All of those are already in Chapter 11, and some will go to 7, which means full liquidation. I mentioned earlier about Jenny Craig. Unfortunately, for a lot of people have used that over the years, but for some reason things didn't do well, and they're gone. So they're basically out of business. Now, here's a major breakthrough from the biotech space. As you know, a lot of my career was spent in biotech in the Bay Area. Eli Lilly, major breakthrough with a drug. Can't pronounce it. It's huge, but it significantly slowed down cognitive and functional decline in phase 3 for early stage Alzheimer's disease and dementia. This is incredible. This is a major breakthrough. And for SID, it's phase 3 right now, and hopefully we'll see this thing continue to get better. Over the years, almost 99% of all the drugs and methods they've tried for Alzheimer's has failed. And so we're further behind in this whole area, but hopefully we'll see some breakthroughs going forward. Burger King continues to struggle. They have less than 7,000 stores across the country, and they're closing another 400 by the end of the year. For those of you in the mortgage business, real estate brokerage firm is closing all of its offices. They were what they call they handle what they call iconic home loans and sales in real estate. And this is a major shakeup in the area because they had $2.6 billion in sales over the past 2 years. They're closing all 3 offices, and all 125 agents will have to find a new location. And finally, we look at Ferrari. Well, Ferrari said, guess what? We're going to stay traditional. We're going to use gas combustion engines. And that's the way it's going to be until they're forced to go otherwise. So for the time being, they're going to continue to build models in that direction. So with that in mind, what I'd like to do now is open up for Q&A. Yeah, a lot of people have a lot